trust in Ivy. And to us, there's no greater duty than being asked to care for your investments. Before we begin, I just need to read a brief sentence or two. Before investing, investors should consider carefully the investment objectives, risks, charges, and expenses of a mutual fund. This and other important information is contained in the prospectus and summary prospectus, which may be obtained at ivyinvestments.com or from your financial advisor. Read it carefully before investing. So today's agenda, we'll talk about the current market environment. I'll mention a few facts about the fiscal and monetary policy that's going on right now within Congress and the Federal Reserve as a result of the recent crisis. I'll talk about a historical perspective. I'll mention some ideas and steps you might want to consider in planning for the future. Talk about some stocks, some companies that we own in the portfolios, and then we'll conduct a brief Q&A. So if there are things that come to mind that you'd like to discuss, I encourage you to remember those, write those down, and we'll follow up later. Global investment markets can be especially turbulent during periods of rapid economic change, such as what we've seen the last couple of months in 2020. And while we can't control the markets, we can try to understand the factors affecting our markets and their implications. So I'm here today to help you understand what's occurring and to provide some perspective. We'll look at the current environment and then review some historical precedent to see how the stock market has performed over the long term. And then we'll also discuss ways that you might approach these opportunities given the current market environment. So this chart shows 2020, and you see a pretty precipitous drop in the red box that occurred earlier this year, mostly in March, due to the pandemic. In fact, over the last couple of months, the pandemic has caused one of the most rapid and dramatic global economic downturns in history. The S&P index, which is broadly agreed upon as the, quote, market, dropped on March 23rd to a recent low, as much as 34% since late December. Now, it's important to note that from March 23rd, the S&P index is up about 25%. More on that later. Global economic activity over the last couple of months came to a near standstill as countries, municipalities, and businesses implemented plans to isolate and help protect people from possible exposure to the virus. It's pretty remarkable that within about 30 days since the virus began, we moved from a relatively strong domestic economy here in the U.S. to a global recession. But the good news is that Ivy doesn't expect that to continue forever. Just as one example, in some of the Asian countries that have reopened already over the last few months, we're seeing about 90% of activity as compared to pre-crisis levels. And the way that they can ascertain that activity level is there's a couple of ways. Apple has a mapping feature that folks in China use extensively. And then also Google Maps, again, utilized heavily in China. Both those platforms can help world economists understand how much activity is going on over there. So they're back to about 90% of activity, including working, trains, subways, cars, etc. So they've rebounded quite well. As people get back to work here in the U.S. and businesses reopen, we're very optimistic that that same activity level could occur here in the next few months. We strongly believe that the Congress and the Federal Reserve have acted quickly enough that we may have avoided long-term damage. And just a couple of examples that you might be familiar with. The CARES Act, which was the first piece of congressional legislation, $2 trillion that provided unemployment assistance, stimulus to small businesses, et cetera. And then, of course, the monetary policy by the Fed, the Federal Reserve, where they came in and added a lot of liquidity to the markets. They helped stabilize the municipal bond market, corporate and credit markets, and they've created a very low rate interest rate environment, to encourage lending. So we believe at Ivy that the government, both in Congress and the Federal Reserve, have done a lot to help minimize the lasting damage of this epidemic. But let's look back at history. And some of you might be old enough to have experienced some of these things. Early 1970s, the Arab oil crisis, 1987 Black Monday, the dot-com bubble, 2008 Great Financial Crisis, and then all the way to the 2020 pandemic. And even though there's been great economic uncertainty over time, you know as well as I do by looking at this chart that the market does tend to go up in the long term. In fact, the S&P index has continued on an upward trend over the last 50 years since this chart lists since 1970, but really since markets began being tracked right around the 1800s, in fact, the markets have pretty much gone up in one direction with volatility. We think that will continue in the future as well. So while market downturns can be discouraging, long-term trends show that the markets tend to reward patient investors. A little bit more history here, more recent, the Great Financial Crisis, 2008. Prior to this current outbreak, this first quarter, the market had experienced the longest bull market run in U.S. history. And that expansion began in right around March of 2009 and continued to the end of 2019, despite much volatility and a few market declines. Statistics show us over the last 100 years, the average bull market lasts about 9 years. And what I mean by bull market is up markets that essentially keep posting record highs. The average bear market only lasts about a year and a half. So the only average down market lasts less than 2 years. And generally over the past 100 years, the market's been up about 80% of the time and down about 20%. A little bit more of a historical framework of what we're working in. Over the last 20 years, this is through the end of March 2020. So from March of 2000 through March of 2020, if you stayed fully invested in the S&P 500 index, you would have had an average annual return of 4.79%. And some years were higher, some were lower, but that would have been your average annual return. But this is very interesting. If you missed just the 10 best days out of those 20 years, you would have missed out on about 1.5% average annual return. And I'm not smart enough to tell you when those 10 best days were. And I believe that's the point, is none of us have any idea over a 1-year period, 2-decade period, or 100 years, what the best or worst days are going to be. So it's impossible to time the market correctly. And just go down the chart here, look at what we missed, just the best 40 days. So a little bit over 1 month period. I don't know when those 40 days were over the 20 years, but you would have had a negative 2.71% return. So this really goes back to my point earlier that the market rewards patient investors. But we think the best way to deal with market changes is to take the time to review your financial plan with the Tedesco team. So with Pat and Karen, we think these periods of heightened anxieties, this is a perfect time to have the conversation with your advisor to make sure that you're staying on track. And what they can do for you, as you know, is help take the emotions out of your money. So we know it's easy to overreact to these types of market movements that we've seen here recently, or that we can become too optimistic when stocks begin to climb. But such attitudes can lead to buying high and selling low, which is the exact opposite of a successful investing strategy. Last but not least, on a historical perspective, you can see the green far outweighs the black bars over that 50-year period. Generally speaking, back-to-back losses over year after year are very rare. You can see that it only happened 2 times in the last 50 years where there was a bad year following a bad year. So even if we're in a bad year in 2020, the markets are down, you can expect, if history's any guide, which is not a guarantee, of course, you can expect that the market will recover next year. So we think one of the biggest ways to help mitigate risk of what's going on is diversify your investments. A mix of different asset classes is important, as well as setting expectations appropriately. We think that by having diversification, you can one asset class can offset another by one gaining and one potentially losing. And again, all these conversations are we think, very timely to have with Pat and Karen. So we encourage you to meet with them virtually when your schedule allows. Just moving on here. These key investment concepts, this is a review. We think it's very important to follow solid investment strategy. Try to take the emotion out of the process. That's why you're working with financial professionals to help you do that. And don't let short-term market fluctuations, good or bad, hinder your long-term plans. If you can, invest regularly, but most importantly, stay committed to your goals. And last but not least, consider all investment options with your advisor. So we think that there's tremendous economic growth going on right now. Many of you have been at home, probably working from your kitchen table or your office, just like I have for the last couple of months, and maybe you're utilizing technologies that you've never used before. Those are investable, and I'll get to that here in a second. There's also lots of news over the last couple of days about a possible breakthrough in a vaccine trial. The company that has been highlighted is Moderna. I encourage you to look it up. It's M as in Mary, O, D as in David, E-R-N-A. Some of you may own this part of the company in your science and technology portfolio if you have it with Ivy, and you may not even be aware. But they just received FDA fast track approval and $490 million in funding by the Centers for Disease Control to help fast track the COVID-19 vaccine. And they're very optimistic. It's in human trials, and it's showing a lot of promise. So healthcare and biotechnical companies like that are ones that we're very interested in, we think are investable, and that as an Ivy client that you've got exposure to. Just some other stock stories that I think will be of interest to you before we get to the Q&A portion. Again, if you're anything like me, you've been sitting at your home, staring at your kitchen cabinets or looking at your yard, and you've decided that it's time to maybe start tackling some of those household projects that you've put off for a long time. Well, in my neck of the woods, and probably yours as well, Home Depot, Lowe's, Menards, and Walmart have all remained open over the last 3 months during the pandemic. And there's millions of people just like you and me that are starting home projects. And one example of a company that they probably utilize is Scott's Miracle Grow. They sell fertilizer and other items to help with your lawn. And their sales are up double digits compared to last year. That's a company that has had an unanticipated amount of growth as a result of what's happening, us all being at home. I mentioned Moderna. Disney is another company, and although their theme parks have been closed mostly for the last couple of months, they have an enormous amount of other businesses that have done really well. One of them would be Disney Plus. Disney Plus now has about 50 million subscribers, and it only launched last fall. Out of the 50 million global subscribers to their streaming service, it's much like Netflix, but with Disney content. Out of the 50 million, 8 million of them are from India. So apparently people in India really like Disney. And we think that it's important that Disney has different business lines that they have rather than just one that may be being negatively impacted with what's happening in the market right now. Just a couple of others that you may or may not be familiar with. Teladoc. So the way that healthcare is consumed, we believe, will be permanently changed by what's happened with social distancing. So Teladoc is an online virtual program where as a patient you can engage with healthcare providers. And of course, their stock has done really well through this crisis. And we think that virtual healthcare interaction is going to be a permanent change in what's happening in the world. A couple of others that might be of interest. If you're anything like me, you've got your laptop in front of you or your desktop computer, and there's no less than 8 or 10 different browsers that are open. And there's data that makes it possible. There's companies that make it possible for you to not lose all that data anytime you open up a browser. and it's called dynamic random access memory. And also there's cloud companies that are backing up all the massive amounts of data that we're consuming. Tens of millions of people at home working from the comforts of their kitchen or bedrooms, also streaming an enormous amount of data. So there's more technology, more data, and more cloud computing that's being consumed right now. So there's companies that act as vendors to all of the technology companies like Netflix, Amazon, et cetera. And we own many of those in our portfolio. So if you have IV funds, you're going to have exposure to several of those names. So what I'd like to do now is address some of the questions that we got prior to the call. And Pat and Karen, if you want to jump in on anything, that's
sure.
Please feel free to. One of the questions was, is this a good time to invest? And if so, how, why, and how? So I'll take the first part of that, and if one of you wants to jump in, feel free. So if this is a good time to invest, why and how? So the market is generally at about a 25% discount to where we were at the end of last year, meaning the S&P index is about 25% off price from where we were at the end of 2019. That's really not that far down. In fact, if you believe like we do that the markets over time, and history has indicated that markets over the long term will continue to go up, even in the midst of short-term volatility. If you can get a 25% off discount, we think that's a great way to go. So if you're able to invest more now, that's great. And we encourage you to consult with your financial advisor on that because everybody's situation is different. But like I said, if you believe like we do, over the long term, markets go up and they reward patient investors. So we think that, sure, now's a good time to be investing. Just moving on here. Overall, thoughts on the economy and the market, I hit a little bit of that, but we do think that what's happening right now is what we're calling a transitory economic event, meaning it's temporary. We don't think that there will be, fortunately, we don't think there will be too much long-term permanent damage on the economy. We do think some industries will change permanently, but by and large, things will somewhat improve slowly as businesses reopen and people get back to work. Some of the other questions that we received, which asset classes or what types of investments have shown to be the safest to invest over the last couple of years? And to that, I'd say the safest is not necessarily the ones that can grow the most. So if you want to be safe, you're going to have to go in what's called money market type products, short-term government bonds, the 10-year treasury, that sort of thing. The 10-year treasury generally doesn't have much growth, and right now it's only yielding about 0.6%. So if you want to have low risk, we suggest that you should set your expectations levels pretty low. There's a question that we got about our portfolio managers, the ones that actually run the portfolios. Are they in a defensive mode, or are they looking for opportunity? And I'd say they're doing much more of the latter, where we continue to own the companies that we think fundamentally look best to us and that can grow the most over the next couple of years. But there's also companies that we've had our eyes on that maybe we think the prices were too high this time last year perhaps, but in the midst of the crisis, as stock prices have come down, that's been an opportunity in some cases for us to buy companies that we wouldn't have otherwise. We're not really in a defensive position right now because we think market fundamentals are pretty good. So it's not like we've been loading up on cash and selling out of good stocks just because we think the sky's falling. I'd say the opposite is the case. One question we received, do we think the market's going to react again if the virus comes back in the fall? That's a great question. So we've just experienced essentially an entire economic shutdown, and luckily and optimistically, the numbers, if you follow what's called antibody testing, there's been a few antibody testing samples done in New York and California, and that's where they'll go into kind of random stores, grocery stores perhaps, and they'll ask people to take a cheek swab and they'll consolidate all this data. And what they found is that many, many more people have had the virus already, and they maybe showed no symptoms. And what that means is the mortality rate potentially is quite a bit lower nationwide than what was earlier reported. And that means that if the virus has a rebound or comes back in the fall or winter, if the mortality rate's a lot lower, it will more than likely mean that we do not need to go through even remotely as much of a shutdown as what we have in over the last couple of months. So if it comes back, we don't anticipate even remotely as much of an economic shock as what's already occurred. What opportunities do we see? The question was, what opportunities do we see in the market? Healthcare technology, streaming, retail products, consumer products, including groceries, consumer staples are investable. If you've encountered what I have over the previous months, where maybe you need toilet paper and paper towels, a lot of grocery stores are just getting restocked right now. Well, those consumer product companies have had an excellent improvement in sales over the last couple of months. One of the questions I got, which I think speaks to timing the market and how I showed you all earlier that it's impossible really for any of us to time the market correctly, because you have the tendency to sell when prices are low and try to buy in when prices are high, which is the opposite of what we should be doing. The question was, can I go into cash and come back when the market gets better? Well, I've got a bunch of credentials by my name that say that I'm somewhat well educated in the financial and economics of what's happening, and I can tell you that I have no idea when the time will be, if you get out of the market now, when the time will be to get back in. So the best suggestion we can make is to stay invested and to have a continuing conversation with Pat and Karen about what your expectations are and what your long-term strategies are. They'll help you form a financial plan. So I think that might have covered all the questions that we got, and that concludes my presentation. Pat?
Yeah, let me
Karen,
just
I'll send it back to
jump
you.
in with a couple of summary to your when's the best time to invest. When you got the money. You can't invest if you don't. Kind of simple. However, a lot of our clients, many who are hopefully listening to this, aren't in the accumulation stage. That's where our planning comes in. Why? Intellectually, we all know and understand when I say the market is not your plan. We have your plan to keep you informed and to guide you through these things. Again, intellectually, we all know that the market is volatile and coming back up, but in times like this, our emotions take over. And that's the advantage you have with us. We hold your hand. Vanguard has come to a planning workshop of financial planners and said they've done some extensive research on how planners help. Primarily, the biggest reason is we hold your hand. And I haven't been successful with all of my clients. One of my younger clients pulled out. Now he's trying to get back in. And I can't get him back in better than he would be if he had stayed in. That goes back to Jay's trying to explain, if you missed X number of days, what are they? So in the nutshell, what Karen and I provide is the reassurance through planning to help you enjoy life and not worry about how to pay the bills and work out between your ability to afford the same number of groceries 10 years from now that you can afford today because we've kept up. Those are my words on it. Karen, what would you add?
Yeah, along the same lines, I think that I've had a lot of calls where, we're really, I tell our clients that during a pandemic like this, during a thing of crisis, whether it be in 2020, 2008, or what have you, Pat and I become financial psychiatrists. That means there is nothing that we can say or do, whether it be talk statistics, just like what Jay has stated, that will make us feel better. Now, we are less financial psychiatrists in May than we were in March. And a lot of our clients were just looking for just, ounces of things to have hope. When in reality, what Jay has talked about is, Ivy Investments and financial planning as a whole is grounded in long-term fundamentals. These things that we're telling you, ladies and gentlemen, they're not anything that you haven't heard before, whether it be from Pat or I or from the news, but they work. They're real. And a lot of times during these crises, we forget about that because it's just too emotional. Our job is to inform you about the risks in your portfolio, and the different approaches that we can make to manage them. We're trying to mitigate risk. We're not trying to alleviate or get out of risk, because again, that bypasses the whole, function of what we're trying to do. And, the topic is I think that you're hiring us and you're working with us to maximize gains, but we're also trying to protect your assets. So that's the reason. That's the real reason why you and I and Pat and I are in this type of relationship, because you don't know it all, and guess what? We don't know it all, but we are here for you, for your planning purposes, and to bring this information to your specific portfolio for your specific goals, because your goals are not anybody else's goals. They're specific to you, and that's what that one-on-one financial planning does. It takes the information that we have on the market and plugs it right into your particular situation. So I think that that's pretty important moving forward. What is this market going to do, and how is it going to work for me later? So, Pat?
Yeah, I just like to kind of summarize Jay's points. He's bringing out all these wonderful companies, and I got to say, well, gee, that's nice, but I don't have the time or the inclination training to be researching all of that. And that's what he's trying to say. You don't need to. The managers of your funds have the time, the training, the temperament, and we pool our money to get a diversified portfolio to protect ourselves in these times. And I was just reflecting on that one slide that Jay showed, a graph with the red box around it, starting back in about
1973.
73. Yeah, I was in the market. I came in after the crash of 69 and telling the broker, when he asked what kind of volatility or risk, oh, let's be aggressive. We'll never have another slide like that. Whoa, 3 years later. Anyway, it's normal. But that's why we plan. diversify. I'd like to, has anybody raised their hand with a question?
Well, here's I think that I needed to have that available to us. What the attendees do have is a chat box. If you look on the bottom of your screen, you're going to see a little chat box. And rather than having any audio, this is where you're going to have your questions. So if you do have any questions, this is the time to type those questions in there. My apologies. The next time that we do this, I'll have that function available to our webinar here. But it looks as though I can't turn the box on. So
is that where it says Q&A?
Q&A, yep.
Yeah.
Q&A, and then but you're going to be, all of our attendees, if you want to type a question in to the chat, and we'll just take a few minutes if there are any, but in the meantime, the follow-up to this is, I would love to hear your thoughts about how you enjoyed this, and then, any type of things that you'd be looking for in the future. I have
one come up.
Omega
Yep.
has a question.
Well, yep. Do you invest our money similarly how you invest your own? Simply put, we all want to make money. If you're making money, we would like to win also.
The answer is yes.
Absolutely.
When we say we invest your money like we invest as if it were our money, it's because we are.
Yes.
Investing it that way. And for the most part, we don't try any timing. Jay's slide of the number of days out of a market, you can't pick them. So.
Yeah, and that to me, ladies and gentlemen, that particular slide of the worst and best 10 days and in and out of the market, that's an attest to what Pat has always ingrained in me. It's time in the market, not timing. And, I know that we have some people on the call that were wary of, just overly crazy and just didn't know how to feel and what to feel. And they did. They went into cash. And now we're trying to work with them and to figure out what's the best solution to get back in. And, Pat and I have always talked about dollar cost averaging back into the market. And that is a good strategy to do now, and just in general. And we can talk about the reasons why one-on-one. So I don't see any other questions. Pat, do you have any last words before we hop off, or Jay?
Just to thank the job he's done. After he does about 250 of these, he'll want to come back and do another one.
Right. I do actually have.
Terrific, Jay. We really appreciate it.
Before we hop off, I do actually have two questions. Sorry, guys. Mrs. Honorato is asking that this was very informative and easy to follow. So are you or you are not recommending us to check in with those companies? This is for you, Pat. Teladoc, Disney, Lowe's, or something like that.
No. That's why we're in funds that do that. They decide when to buy, when to sell, and we reap the benefits.
Okay. The last question here is my IRA is pretty much depreciated based on this market. What should I do? Should I dissolve it? Should I keep it? What should I do, knowing that my IRA has depreciated a bit.
It also has gained back.
That's right.
From the bottom, March the 23rd to in the next 6 weeks, as Jay said, you've gained back pretty near half of what you gave up. And over the long term, you're going to gain it back. Just remember, what appears to be safe, meaning the principal is safe, you can't buy the same number of oranges today that you bought 10 years ago for the same price. Through planning, we're better in enabling you to be prepared for those oranges.
Right.
No,
that's a great answer. I really do appreciate everybody being on this call. This is probably going to be one of many. In these times, it's going to be probably one of the best and easiest way that we can get in front of our clients and your friends and family to do these answers and the questions and answers, and to give you information in the best way forward, knowing that we have some folks in Florida and South Carolina. So I really do appreciate your time here. I will be probably reaching out to all of you to see how you really enjoyed it. And if there's any questions that we have not answered.
Yeah, Tommy has a question. Do you see it?
Tommy, no question. She just likes very, very informative and good basics, so that were being reinforced. So all of these questions are answered. So with that further ado, I will go ahead and sign off, ladies and gentlemen. I thank you for your time, and we will be chatting with you here in the next couple days.
I just
Thanks,
like
everybody.
to close it with
Thank you.
saying thank you to Jay, but these are the good thing is we're learning how to contact you and hold your hands more often in this group way. And I'm glad to see that it's useful.
Great.
Jay?
Yes, thank you, everyone.
Okay.
Alrighty, ladies and gentlemen, have a great rest of your day, and we will be speaking with you soon. Take care now.
Take care.
Thank
Bye.
you. Take
Bye-bye.
care. Bye.